Before we get to today's show, I wanted to share a quick reminder that being financially organized is one of the biggest factors in building wealth. Want to be a millionaire? It's not going to happen if you're not organized with your money. So, how can you get organized? Well, our favorite app is Empower. It's free, allows you to connect your banks and brokers, and it gives you daily income and expense updates. Ready to try it out? You can sign up at thecollegeinvestor.com/empowermoney. What's up? This is the College Investor Audio Show. We're so glad you're hanging out with us today. Let's take a look at this. So here's why consolidating your student loans in 2026 can actually set you back. So we'll take a look at that in just a second. A fast reminder, though. If you hear an article on the podcast, you can always find it inside our website at thecollegeinvestor.com. Resources and everything, all the links that you need to get all the information you need on every single topic. You can find it at thecollegeinvestor.com. Ask us questions, get to know us. We'd love to help you wherever you are in your money journey. Type in the words The College Investor in social media. We're probably there. All right, here we go. Let's get to this consolidating loan business. So for most of our borrowers, we are now post July 1st for the OBBBA stuff to kick in. Consolidating federal student loans is no longer really an upside. It can quietly erase progress you've already earned towards loan forgiveness. The one situation where it still helps out is getting out of default. Consolidation used to be a helpful tool for a whole lot of people. It turned old FFEL loans into direct loans, unlocked income-driven repayment, public service loan forgiveness, and let borrowers capture the one-time IDR account adjustment. But those windows have now closed. The adjustment is over. FFEL cleanup deadlines have passed. The menu of repayment options is shrinking, so the cost-benefit math has kind of flipped for most people. But there is no real requirement for any borrower to consolidate at this point in time, and except for defaulted student loans, doing so may be more harmful than helpful. Here's what's changed. First, all the Biden-era waivers and all the forbearance and all the stuff to make consolidation helpful, those have all expired. Second, and we're already into this, now that we're after July 1st, a slate of new repayment plan and loan options went into effect. Some of them are good. It's really no big deal. But if you consolidate your student loans now, and anyone who has after June 30th, 2024, by the way, your progress toward IDR forgiveness resets to 0. For PSLF, consolidation takes a weighted average of the qualifying payment counts on your old loans, which can drag your count below your highest counting loan. Grr. So for Parent Plus loan borrowers too, consolidation used to offer a pathway to income-driven repayment. However, for all new Parent Plus loans, including those consolidated after July 1st, there will be no access to income-driven repayment. And finally, major repayment plan access change if you consolidate. So any consolidation loan dispersed on or after July 1st strips access from here on out to every repayment plan except the new RAP, Repayment Assistance Plan, or a tiered standard plan. Both could be good options, too. Consolidating now doesn't just fail to help, it can actually lock you out of options you have today. Now, here are some more costs borrowers tend to forget. Consolidation doesn't really change your interest rate either. The new rate is the weighted average of your existing rates rounded up to the nearest 1/8%. You don't save money by consolidating, and it could even cost you the tiniest bit more. Two other costs hide in the fine print. Any unpaid interest capitalizes onto your principal, so you start paying interest on a bigger balance. And a longer repayment term, sometimes stretching from 10 to 20 years or more, lowers the monthly payment while raising your interest paid over the life of the loan. We all knew this, though, right? What student loan consolidation does help with is getting out of default. If you're in this predicament, consolidation remains a legitimate option to get out of default and to get out of student loan debt. There are 3 ways out of default: pay your thing, pay it, just pay the thing, rehabilitate, or consolidate. Consolidation is, of course, the fastest. It can resolve default in weeks rather than the 9 on-time payments rehabilitation requires. The trade-off, though, is consolidation leaves the default on your credit report for up to 7 years, while rehabilitation removes it. Let's connect the dots. The College Investor has long flagged that consolidation is widely oversold. Our coverage of student loan rehab walks through why borrowers exiting default should weigh rehab's credit repair benefit against consolidation's speed. And as we noted, in why some borrowers must consolidate before June 2026, which is now long gone, the narrow must consolidate cases, which would be like FFEL and Parent Plus holders protecting IDR and PSLF access, so a very limited group of people, were tied to deadlines that have now passed. Going forward now, treat consolidation as a default recovery tool and nothing else. If you're current on your loans and you're chasing forgiveness, consolidating is more likely to set you back than move you ahead. Confirm your own situation with your servicer or at studentaid.gov before signing anything. That is our show for today. Hope it was helpful to you. If you have any questions, comments, concerns, anything at all, just like and follow on social media. Search for the words The College Investor. You'll find us. Thanks again for stopping by today, and we'll talk to you again real soon.